Welcome, Curious Mind, to another deep dive. Today, we're tackling a really big one, the 2008 financial crisis. You've definitely heard the headlines, maybe even felt the effects, but what really happened? What pushed us so close to a global economic meltdown? We're digging into the sources you send over to get to the bottom of it.
Yeah, it's definitely a complex story, a huge tangle of financial products, practices. It's a lot. Our goal today is really to cut through some of that noise, look at your sources, and help you understand the core mechanics, the key moments that really define this pivotal time in modern economic history. Think of it like peeling an onion, getting to the layers underneath that built up the pressure.
Okay, let's peel that onion then, because, a lot of people might think 2008 just sort of happened, appeared out of the blue. But your sources make it pretty clear there was a long fuse burning. What was going on in the years before that set the stage?
Yeah, absolutely. The groundwork, it was definitely laid by some major policy changes. Like back in 1999, when parts of the Glass-Steagall Act were repealed. That was crucial because it let institutions mix regular commercial banking, usually pretty low-risk stuff, with much higher-risk investment banking. It basically opened the door for a lot more speculative behavior.
Right, so blurring the lines between safe banking and riskier bets. Okay. What else was adding to that pressure early on?
Well, alongside that, you had the Federal Reserve. Between 2000 and 2003, they dropped the federal funds rate, like dramatically, made credit super cheap. And you combine that with some laws from the 90s pushing for more affordable housing. It sort of inadvertently pushed banks towards targeting lower income minority homebuyers with riskier loans. And the regulators, they were, well, mostly looking the other way, unfortunately.
Okay. And that's where the housing bubble really starts to inflate, isn't it?
Yeah.
The sources you have mentioned, prices just soaring.
Exactly. So get this. Between 1998 and 2006, the price of a typical American house jumped 124%. Staggering.
Right.
And that ratio, median home price to median income, historically it's around, say, 2.9 to 3.1. By 2006, it hit 4.6.
It's a huge jump.
Huge. And it was fueled by this thing people called the giant pool of money. Basically, $70 trillion in global investments hunting for better returns. And Wall Street was happy to oblige, creating things like mortgage-backed securities, MBS, and collateralized debt obligations, CDOs.
Okay, so tons of global cash flooding the U.S. housing market. Everyone's scrambling to create more mortgages, even really shaky ones, to feed this machine. Did anyone see this coming? Were there red flags in the sources you looked at?
Oh, absolutely. Several clear ones. As early as May 2005, you had this fund manager, Michael Burry, maybe you've heard of him, betting big against subprime mortgage bonds. He saw the instability coming. Then by 2006, house prices peaked, delinquency started rising, and get this, a third of all mortgages that year were subprime or no-doc loans, no proper documentation.
A third.
Yeah. And your sources show warnings from big players like JP Morgan in May 6, UBS in November 06, talking about an impending crisis.
Yeah.
Even the yield curve inverted in August 2006. That's a classic recession signal. It was all there, really.
The timeline definitely shows those tremors getting stronger. And what really struck me in your sources is how they stress. It wasn't just one thing. It was interconnected, right? What did things like the Financial Crisis Inquiry Commission, the FCIC, and other reports say were the main causes?
Oh, far from one thing. It was a perfect storm almost. What you see from the FCIC report, the Levin-Coburn report, it's this picture of systemic breakdown, not just isolated mistakes. They point to three main things, really. First, massive failures in regulation and supervision. The Fed just couldn't stop the wave of toxic assets. Second, huge failures in corporate governance and risk management. Firms just acting recklessly, taking on way too much risk. And third, just an explosion of borrowing, excessive debt, risky investments, and a real lack of transparency from big institutions right down to households. Accountability got spread so thin.
So, lack of oversight, bad internal decisions, and just this mountain of debt. You mentioned the debt figures earlier. They're mind-boggling.
They really are. Like, U.S. home mortgage debt compared to GDP was around 46% in the 90s. By 2008, it hit 73%. That's $10.5 trillion.
Same.
And household debt. By late 2007, it was 127% of disposable income. People were just borrowing like crazy.
It's just staggering.
Yeah.
And these risky loans, the subprime ones, were central. Tell us more about that. What made them so dangerous?
Yeah, the standards for subprime lending just fell off a cliff. By 2005, lenders were okaying FICO scores down to 620. Proof of income, assets, often just glossed over, led to these things called N9G loans, no income, no job, no assets. Seriously.
NING loans. That sounds made up, but it was real.
Oh, very real. It basically encouraged people to fudge applications. There was this whistleblower from Citigroup who testified that by 2006, like 60% of the mortgages they bought were defective. By 2007, over 80%.
100% defective.
Yeah. And your sources mentioned this company, Clayton Holdings. They checked loans, found that only about half the loans from early '06 to mid '07 actually met the lender's own standards, and almost 30% met none of the standards. Yet nearly 40% of those bad loans packaged up and sold to investors anyway.
So knowingly packaging and selling bad debt, it sounds almost like fraud on a massive scale. And then the financial innovation part, the CDOs, how do they make it even worse?
Right. So CDOs bundled tons of these mortgages, other debts into new securities, and issuance just exploded. Went from like $20 billion in early '04 to over $180 billion by early '07.
Wow.
But the core problem was the quality inside these CDOs was dropping fast. More and more subprime junk was getting mixed in, and they were so complex nobody really understood the true risk. Even the rating agencies, they used these flawed models. Like Lee's Gaussian copula formula Wired magazine called it the formula that killed Wall Street. A bit dramatic maybe, but it highlights the issue.
So the tools designed to manage risk actually hid and amplified it.
Yeah.
And nobody quite knew how dangerous the whole structure was becoming. What about regulation? Apart from Glass-Steagall, any other key failures?
Yeah, another big one was the SEC, the Securities and Exchange Commission. In 2004, they relaxed something called the net capital rule. Basically let investment banks take on way more debt. Leverage went through the roof, which fueled that whole MBS boom. And crucially, this whole shadow banking system grew enormous. Investment banks, hedge funds, entities not regulated like traditional banks. They were super leveraged, borrowing short-term cash to buy these long-term, hard-to-sell assets like MBS. It was incredibly fragile. Paul Krugman called the lack of oversight malign neglect.
Yeah.
A pretty damning term.
Malign neglect. It really paints a picture, doesn't it? A house of cards just waiting for a gust of wind. And that wind really picked up in September 2008. Your sources paint that month as the absolute breaking point. Walk us through those key events.
Yeah. September '08 was intense. It kicked off with the government basically taking over Fannie Mae and Freddie Mac on September 7th. I mean, together they owned or guaranteed something like $5 trillion in mortgages. Huge.
Right. And then the big one, Lehman Brothers.
Exactly. September 15th, Lehman Brothers, the fourth biggest investment bank in the U.S., files for bankruptcy. The largest bankruptcy in U.S. history.
And the market reaction.
Immediate panic. The Dow Jones dropped over 500 points that day, worst drop in 7 years. Then, the very next day, the Fed had to step in and bail out AIG, American International Group.
The insurance giant.
Yeah, the biggest insurer. They needed an $85 billion loan because they had sold so many of these credit default swaps, basically insurance on debt. If AIG went down, it would have taken countless others with it.
So AIG, the symbol of stability, suddenly needs life support. What else was happening? You could feel the system seizing up, right?
Oh, yeah. On September 17th, people pulled $144 billion out of U.S. money market funds in a single day. That's like a bank run, but on these funds that companies use for daily cash.
A bank run.
It completely froze short-term lending. Companies couldn't get cash for payroll, for operations. Real fear set in. Then on the 18th, Treasury Secretary Paulson and Fed Chair Bernanke had that emergency meeting with Congress. Bernanke supposedly said something like, if we don't do this, we may not have an economy on Monday.
Chilling. Just absolutely chilling. And that led straight to the big government bailout package.
Exactly. TARP, the Troubled Asset Relief Program, $700 billion. Though remember, the House actually rejected it at first on September 29th. The Dow dropped another 777 points that day. Historic plunge.
Right, I remember that. Chaos.
Total chaos. But they eventually passed it, and President Bush signed it on October 3rd. But even before TARP passed, Washington Mutual Bank failed on September 26th, the largest bank failure ever in the U.S. And it wasn't just the U.S. The crisis went global, fast. Central banks coordinated rate cuts. The IMF warned about a systemic meltdown. Iceland's stock market dropped 77% in one day.
Just incredible. So the government steps in with TARP, other interventions. What was the immediate effect? How did the economy start to pull back from the brink?
Well, the interventions were massive. Trillions globally in bailouts and stimulus. In the U.S., besides TARP, you had the Recovery Act in 2009 under President Obama, another $787 billion stimulus. And the Fed started quantitative easing, QE, pumping trillions more into the system. These actions, plus efforts worldwide, they did manage to stop the free fall. The worst of the recession technically ended by mid-2009.
Okay, so the immediate fire was put out, but the sources you've got make it clear the damage was deep and lasted a long time. What were some of those longer-term impacts?
Yeah, absolutely profound. In the U.S. alone, about 8.7 million jobs lost. Unemployment hit 10% by October 2009.
10%.
Yeah. The Dow Jones, it fell 53% from its peak in late 2007 to its low in March 2009. And household wealth. Median wealth in the U.S. dropped 35% between 2005 and 2011, wiped out years of gains for many families.
35% loss in wealth. That's devastating.
It was. And interestingly, your sources point out that income inequality in the U.S. actually grew during the recovery. That was a first for the country after a downturn.
Wow. That's a really stark outcome. So what changed? What regulations came out of this mess to try and stop it from happening again?
Well, the biggest piece of legislation was Dodd-Frank, the
Yeah.
Dodd-Frank Wall Street Reform and Consumer Protection Act. Signed into law July 2010, it was a massive overhaul aimed at regulating derivatives, increasing bank capital, creating the Consumer Financial Protection Bureau, lots of things.
Mhm.
Globally, countries also adopted stricter rules like the Basel III standards for bank capital and liquidity. And there were efforts, to increase oversight of things like credit cards and mortgages, try to prevent predatory practices.
Okay, so significant reforms on paper. But what about accountability for the individuals involved? Did people go to jail?
That's a really contentious point. Globally, the numbers aren't huge, but 47 bankers did serve jail time. Over half of those were in Iceland, actually, where the crisis hit incredibly hard.
Iceland, okay. What about the U.S.?
In the U.S., your sources say only one senior banker actually went to jail, Kareem Sarageldin from Credit Suisse, for hiding losses by manipulating bond prices.
Just one.
Just one from a major bank related directly to the crisis activities. Nobody in the UK was convicted either. Now, firms paid massive fines. Goldman Sachs paid $550 million in a settlement over fraud charges related to CDOs. But individual criminal convictions at the top, very few. It often comes down to the difficulty of proving criminal intent for specific individuals within such a huge, complex system failure. Much easier to pursue civil cases against the firm.
Right. That difference between corporate fines and individual jail time is something a lot of people still talk about. It feels unsatisfying, maybe. Looking back before the crisis, though, you mentioned Michael Burry. Were there other economists or experts who saw this building, or was it mostly missed?
It's mixed. Many mainstream economists definitely missed it or downplayed the risks, but your sources do highlight others who were sounding alarms. Robert Shiller, famous for the Case-Shiller Housing Index, he specifically warned about the housing bubble bursting. You had Peter Schiff, who was very vocal on TV for years, though maybe seen as a bit of an outlier then. Raghuram Rajan, who was chief economist at the IMF in 2005, gave this paper warning about huge risks building up in the financial sector. It was apparently quite controversial at the time. And Nassim Nicholas Taleb, author of The Black Swan, he consistently warned about the fragility of the banking system and its reliance on these flawed risk models. So the warnings were there, just perhaps not always from the expected places or not taken seriously enough.
Fascinating. So we've traced this incredible story, this intricate web of policy, finance, human behavior that led to the 2008 crisis, all based on the material you brought together. From those NINJA loans and complex CDOs to the shadow banking system and the regulatory gaps, it's clear it was a breakdown on many levels.
Absolutely. And connecting it all, thinking about the bigger picture, it really leaves a question for you, listening out there. We've had major reforms like Dodd-Frank. We learned some incredibly painful lessons, but what underlying forces might still be at play? Things like, our constant drive for economic growth or the way financial innovation always seems to outpace regulation. Could these be setting us up for future challenges? What really stands out to you about how our own behavior and these big systemic pressures keep feeding into these boom and bust cycles? Something to think about.